Hi, I'm Sharon Winsmith, a tax attorney, active investor, and your go-to resource for proven investment and tax planning strategies. In this video, I'm going to talk to you about some unique year-end tax planning ideas that anyone who wants to build wealth and reduce the taxes they pay should consider. This is not the type of stuff you're going to hear from your CPA or whoever prepares your tax return. This is really the types of things that really sophisticated, savvy investors focus on in order to build more wealth and pay less tax. So let's go ahead and dive right into what I think are the main year-end tax planning ideas that anyone should think about. To start with, you should go ahead and be thinking about doing that backdoor Roth IRA conversion if you haven't already this year. I know some people like to do it all in one shot, and some people like to spread it out over a couple of years so that they can stomach the tax bill better. But we need to go ahead and do those backdoor Roth IRA conversions while we still can. I have a lot of other videos on this topic about why you should do that, why we prefer Roth IRAs as opposed to 401ks and IRAs, traditional IRAs. So if you aren't familiar with that and the concept of how you do not want to build wealth inside a 401k or IRA, you would rather get that into a Roth IRA as soon as possible, check out those videos, but don't forget to do this. You want to do this sooner rather than later because we don't know what's going to happen with the next election cycle. And Democrats have indicated a willingness or a desire to try to close this loophole so that the wealthy can't do things like backdoor Roth IRA conversions and build wealth inside a Roth IRA where you're never going to pay tax again. So you want to go ahead and do those as soon as possible. You are going to have to pay tax on the full amount that you roll over. You cannot use any money inside the account to pay the tax bill, so you do have to have the liquidity available to pay that tax bill next year. But this is definitely something, if you've got a bunch of money in a 401k or traditional IRA, this is definitely something you want to look at as far as doing sooner rather than later while you still can and before Congress shuts down that loophole. Okay, next is gifting to your children. So if you're not familiar with this concept, it's the best estate planning tip or tool that everyone should be doing that has, the amount of money or the wealth to do so. So you can gift tax-free a certain amount to every child every year. You don't have to file a gift tax return. You don't have to pay any gift tax at all. This money completely comes outside of your estate. So you want to make sure you are taking advantage of that every single year. You want to do this any year that you are physically able to afford to make the gift. And you can do $17,000 in 2023 per child per spouse. So that means a married couple can give $17,000 each to each of their children. So this is a great way to get a bunch of money outside your estate. You don't have to file anything, and you want to transfer that money to your kids as soon as possible. I don't care how you do it. If you want to set it up in some sort of, directed account where the kid can't access that money until they reach a certain age, that's fine. Just make sure you are doing this. Do not use this to, with trust or anything like that. I don't like trust. I think the vast majority of trust that estate planning attorneys sell are actually scams where, there's a joke in the industry that the only person who really benefits from setting up a trust is the estate planning attorney. So you want to get these in accounts. You want to get these in brokerage accounts or whatever. You also can gift shares of your business. So the $17,000 doesn't have to be cash. It can be, stocks that have appreciated in value. You can give $17,000 worth of stocks. You can give, a piece of a business that's worth up to $17,000. So there's all different ways you can do the gifting, but you want to do this every single year. Do not miss 1 year. Gift as much as you possibly can afford. That's the best estate planning tip out there. It's the easiest, and it's one that every single person should be doing if you have got enough wealth that you're going to want to pass something down to your kids. Okay. This is not being talked about as much about making real estate investments to get bonus depreciation. This was really popular last year when it was 100% bonus depreciation. What that means, I'm not going to dive into detail on this, but you can invest in things like real estate funds or go out and buy real estate, and you can do a cost seg study and get a bunch of bonus depreciation. So we know when we invest in real estate, a big benefit of that is the tax deductions we get for depreciation every year. But bonus depreciation lets us accelerate a bunch of that depreciation to the current year. So you're building up these big losses that can offset future income from other passive investments in the future. So if you're an active real estate professional, then those losses can actually offset all of your income. But most of us are passive real estate investors like myself. So we're looking at offsetting passive losses in the future and building up these carry forwards. You can still claim in 2023 80% bonus depreciation. It's not 100% like it was last year, but you still want to make those real estate investments sooner rather than later so that you can start generating those losses. Crypto tax loss harvesting. So I know at the time I'm recording this, crypto is actually starting to come out of that crypto winter. I think right now Bitcoin's at 34,000. However, a lot of people still have losses if you've been a long-term investor in crypto and especially different forms of cryptocurrency. So to the extent you have losses in your crypto, you want to think about doing tax loss harvesting. There's still that loophole available in the law where you can immediately sell, you sell your crypto, take the losses for tax purposes, and then you can immediately buy that same crypto back and hold that indefinitely. So you want to take advantage of this while you still can. Congress will shut this down sooner rather than later. I do not expect that this will remain a possibility much longer. There are wash sale rules that apply to things like securities that prevent you from being able to sell something at a loss and then buy that same thing right back and hold it. So you're just kind of manufacturing tax losses. However, those laws do not currently apply to crypto. So you still want to do that. You can actually pick basis, and that's a big benefit here is that you may have Bitcoin you paid $50,000 for, and you may have Bitcoin you paid $20,000 for, but you can sell the Bitcoin at a loss for what you paid $50,000 for and apply that $50,000 basis so you can have a higher loss. You can cherry pick your basis, want to apply the highest basis possible so that you can have as high a loss as possible when you do this. I have another video on crypto tax loss harvesting where I walk you through how to do this and how to pick your basis and allocate it across the different tax lots. Make sure you check that out if you're someone who still has some losses in your crypto. If you're a business owner or you have a side hustle, you want to reassess your salary. When I was doing consulting for clients in the past, I don't think anyone ever came to me where I thought that their salary that they were paying themselves from their business wasn't way too high. Remember, W-2 salary income, whether you're a business owner or a full-time employee, is the absolute worst type of income you can earn. It is taxed at the highest rates. It is the least efficient type of income. You want that salary to be absolutely as low as possible in most cases, unless you're trying to optimize your qualified business income deduction, which that gets more complicated. I talk about that in detail in my business tax strategies course. But for all intents and purposes, we almost always want our salaries, whether we're business owners or W-2. W-2 employee is different because you want to get paid more. But if you're a business owner or have a side hustle, you want what's your salary, what's coming to you from the business as a W-2 as opposed to what's coming to you as a draw or distribution from the business. You want salary low as possible, distribution high as possible. So make sure you reassess that. Make sure you can't take a position that your salary should be lower based on how much work you're doing for the business. That's very important. I've never seen, CPAs usually don't get this right because they don't really understand the industry, but especially someone who's running an online business where you're much more passive than someone who's working, 12 hours a day running their own business. You can really justify a really low salary in those cases. So make sure you're looking at that and paying yourself a reasonable salary and taking positions that it could be lower to the extent that's available. If you're a W-2 full-time employee and you do not have some sort of side hustle, I cannot stress to you enough how important it is that you create one. This may sound crazy. You may be telling me I don't have the time. Well, then you don't have the time to build wealth. If you want to get be financially free at some point early in your life, you've got to have a side hustle or be a business owner. That's my own personal opinion. That's the way I've seen it in practice. I've really very rarely seen, W-2 full-time employees spend 100% of their time working their day job and become financially free early in life. So start a side hustle. Don't wait. Stop waiting. You need that side hustle so that you can take tax deductions against things that are otherwise personal expenses or things you can't deduct. You need a side hustle to start building wealth more efficiently in a way that doesn't require you to exchange your time for money. So there's any number of reasons why you need a side hustle, but stop waiting. Don't, stop being scared. Go ahead and start that side hustle as soon as possible so that you can start building wealth and taking tax deductions and earning money in a much more efficient way than you are as a W-2 employee. Lastly, and this one may seem kind of silly or obvious, but learn tax planning strategies. You are not going to hear from your CPA tax planning strategies that are really being done by wealthy, sophisticated investors. You're not going to hear them talk about the things like buy, borrow, die, like how to invest in real estate passively in a way that you don't have to spend a lot of time, but you can, build wealth efficiently and from a pure passive standpoint. You're not going to learn about my strategy that I've come up with where you become a passive business owner and, you can basically offset your real estate losses with your business income. So you have got to, this is kind of the unfortunate truth of where we are today. The really thought leaders in the tax space are not working with clients. They are doing thought leadership stuff. They're doing things like YouTube videos and podcasts and writing books. And yes, a lot of what those people say I disagree with. I see a lot of crazy wrong stuff out there and hear a lot of really scary things said by those people, a lot of them. But just that's the fact of the matter is that the people who really understand the sophisticated tax planning strategies just aren't working with clients anymore. So you've got to be in the driver's seat. You've got to learn tax planning strategies. I have a number of courses on these topics, from investment tax strategies to business owner tax strategies, to buy, borrow, die strategy, which you cannot build wealth without understanding buy, borrow, die. You have to understand that strategy. You're not going to find a lot of people out there that have even heard of it or let alone know how it should work in practice. So learn tax planning strategies. This is really important. It's your biggest expense is going to be taxes. It is not your mortgage. It is not your health insurance. It is taxes. If you don't plan properly, it could eat into over half of the money that you make in your future. So you have got to invest the time and money into learning good tax strategies. So now that we've talked about what you should do as far as year-end planning, I want to talk to you about the things you should not do. So this list is largely things you're going to hear from your CPA or whoever prepares your tax return. And maybe if you listen, to some influencers out there in the space, they may talk about this, like, make sure you get your solo 401k set up and max those out. Those are terrible ideas. Those aren't strategies used by wealthy people. So if you're really focused on building wealth and paying less tax and really building wealth in a way that you pay little to no tax, like the wealthiest people in this country do and the smartest people do, then these are not things that you should be doing. So when you go to your CPA or you listen to what are the tax planning strategies I should do for year end, I always hear them say prepay expenses and max out 401ks and IRA contributions. Those are two really bad ideas. Those are two ways to really, first of all, not build wealth efficiently, and also ways to ensure that you pay a ton of tax when you're retirement age. So prepaying expenses doesn't make sense. You don't want to prepay expenses. Tax rates right now are as low as they've been in modern history. We know they are going up in a couple of years unless Congress acts to, extend the Trump tax cuts, which I wouldn't see that as likely. I'm not a betting person, but I wouldn't bet the tax rates are going to go down or that these tax cuts that Trump put in place are going to be extended. So prepaying expenses doesn't make sense. Also, you're much better off taking that money that you have, if you have extra money to prepay those expenses with, you're much better off investing that in something and earning a return rather than paying expenses earlier than you need to. That's crazy. Cash is king. You want to invest that money, put it to the most productive use possible. You're happy to pay more tax today, but this prepay expense thing is you're just kicking the can down the road, and it makes absolutely no sense. It goes against any kind of, basic common sense. I think that someone who understands investing, building wealth, and tax planning really, would get. So I talk a lot about 401ks and IRAs. Unless you're doing some sort of mega backdoor Roth IRA conversion strategy, I would not max out 401ks and IRAs. I do not have a 401k or an IRA. I do not intend to ever have one of those. You do not want to build wealth inside of a 401k or traditional IRA. I'm not going to belabor this point. I've talked about this a lot. If you don't understand that now, you are behind the curve. You need to understand that this is outdated. This is really a mess. I've talked a lot about the ticking tax bomb, where you've got these people reaching retirement age with, several $1 million in their 401ks or IRAs, and how much of a disaster it is from a tax standpoint for them. So I'm not going to talk about this any further. If you don't know this concept now, and if you're still maxing out contributions to 401ks and IRAs, you need to check out my other videos, because that is not the path forward. That is not really what smart, wealthy investors are doing. Okay. Also, pay yourself. I hear this a lot. Luckily, I don't hear it as frequently as the others, because this is really, really scary. Sometimes CPAs will say to pay yourself a higher salary so that you can make IRA contributions. There's a lot of ways we work with business owners where they don't even need to pay themselves a salary, or if they do, it's so small because they're very passive with respect to running their businesses. But I've heard them come to me, and this is really scary. This is actually malpractice. If your CPA is doing this, you need to run out the door and find a new one, because I firmly believe that this is malpractice. CPAs are telling the business owners to pay themselves a higher salary so that they can fully max out the available contributions to their retirement plans. Don't do that. I'm not going to, talk about this any further. That's a disaster. Salary income is the absolute least efficient type of income that you can earn. So the idea that you would pay yourself a higher salary when rates on business income, net business profits right now, are as low as we'll probably ever see in the rest of our lifetime, that is just ludicrous. Don't do that. That's really scary, and you should get rid of that CPA. I do think a lot of CPAs don't focus on tax planning, but this is just dangerous and really scary. Okay. A lot of people are talking about like the Section 179 deduction, where you can go buy a big truck or a large SUV and get a write-off. Don't do that. Don't ever buy something. Don't ever invest in something or buy something just because of the tax write-off. That alone is never justifiable. I'm not going to go out and buy, some big SUV just so I can get the tax write-off. If you need a new truck for your business, great, go do it. Get the tax write-off, that's great. But don't ever just to buy something, and don't invest in something. I know a lot of people like to invest in solar credit funds, like, funds where they're buying solar equipment and they get the solar tax credits. Don't ever make an investment where the pure reason you're doing it is for the tax benefit. The investment needs to stand on its own by itself. whether you're buying something for your business or whether you're investing in a fund or something else, you need to make that investment or buy that thing on its own, regardless of whether or not the tax benefit. If you don't need it, don't go out and buy it. I think that should be pretty self-explanatory. But I hear a lot of people talk about, going out and buying trucks for your business. I wouldn't do that. Buy the truck when you need a truck. So it just doesn't make a lot of sense to buy something or invest in something solely for the tax benefit. Something I do want to stress, and I don't think it's talked about enough, is I think people make the mistake, and I think this is the difference between really savvy investors and people who really, understand how to build wealth efficiently as opposed to just kind of your middle-class business owner, is a lot of people waste too much time on low-hanging fruit. I see this happen a lot in practice when I used to do consulting. This, I think, is a big mistake. If you are a business owner, for example, yes, you should do the strategies of the S Corp payroll tax. Yes, you should do the home office deduction. Yes, you should hire your kids and pay them something from the business to get the tax deduction. But don't waste too much time on this. This is low-hanging fruit. These are tax planning strategies absolutely everyone should be doing. Take my course about the business tax planning strategies. Learn every single tax strategy you as a business owner should be considering. But don't waste so much time on these tax strategies that are only going to save you a couple $1,000s a year. That is not where, that's not going to make a big difference in the long run. You want to be investing your time, money, and effort in the big, sophisticated, cutting-edge tax planning strategies. So buy, borrow, die. Understand how you can take money that you make from your business or your W-2 job, invest it in a way that you are efficiently building wealth while paying no tax on that money ever again or any money that money earns. Those are tax planning strategies that you should invest a heck of a lot of time and money and effort on learning instead of whether or not, how much should I pay my kid that I hire from my business? I see people just spend so much time on that. Do I need an S Corp or, do I not? Should I wait to make the S Corp election? Those are strategies you should know. They're pretty low-hanging fruit. Everyone should understand them and implement those, and get the best result. But you should be investing most of your time in real tax planning strategies like buy, borrow, die, like real estate investing, like active real estate professional status, like my passive business ownership approach, but like creating a side hustle to get tax deductions and build wealth. Those are where the money lies. That's what's going to be the difference maker and a game changer for you as far as the ultimate wealth that you're able to make over your lifetime and how little, and how you can reduce the ultimate taxes that you have to pay on that money. Last, I'm going to talk about what I think is the most popular, or, at least anyone who invests in the stock market has heard of this. And a lot of financial advisors tout this as what they do. Tax loss harvesting on stocks. So yes, I said before, do tax loss harvesting on crypto. Why I like that is if I have losses in my Bitcoin, I can sell that Bitcoin and I can buy it right back tomorrow. So I'm still sticking with my investment strategy. I only invest for the long term. Smart investors only invest for the long term. I'm not owning Bitcoin and Ethereum, thinking I'm going to sell those in a couple years. I'm owning those thinking what's the value of those, of my Bitcoin and Ethereum going to be, 30 years in the future. I don't care what it is tomorrow. So I'm a long-term investor in those assets. If I have to do tax loss harvesting, I can't buy that Bitcoin or Ethereum right back, then that goes against my strategy, right? I'm not sticking to my guns there as far as what my plan is. With stocks, you cannot buy the same stock back. And it probably means you're either investing in mutual funds or, toggling between, different types of stocks. So, you could sell Apple and maybe buy Coca-Cola, but you're cherry picking or you're doing stock picking. We know those are bad ideas. So first of all, if you're doing tax loss harvesting, if you have tax losses in your stocks, it probably means you're not a long-term investor. It probably means you're not investing in low-cost index funds like, Vanguard S&P 500 index fund, which is our preferred, way to invest in the stock market, in my personal opinion. So, if you're able to do tax loss harvesting, then you probably need to reassess your stock strategy and how you're investing, or it's probably something your financial advisor's doing, trying to justify their fees. You should not have losses in your stocks. So you should never invest and lose money. This is the whole problem with cherry picking, is that some of your stocks, maybe 90% of them go up, but you've got 10% that are a loss. So you sell that 10% and you recognize the tax loss and buy something else. Why are you investing in that 10% that has a loss? Yes, if you invest in an S&P 500 index fund, you could have a loss in your stocks. You probably won't, especially if you've been doing, investing and putting more money into it over the long term. So the point I'm trying to make is that if you are doing tax loss harvesting in your stocks, you need to rethink about your stock investment approach, because you should not be having losses in stocks year over year. You should not be doing stock picking. It is not efficient. yes, you may get some capital losses, but you're cutting against the efficiency of the ultimate earnings that your money's making. So if tax loss harvesting on your stocks is even something available to you in more than 1 year, I would reassess what the heck you're doing as far as investing in the stock market and if you're doing it right. So these were just a couple of examples of good year-end tax planning tips. I think a lot of people aren't really talking about what I think is really important that I mentioned, or the ideas that you should focus the most of your time and effort on. And also what I think is just as important is what you should not be doing, who you should not be listening to, and what you should not waste time on, which is these. And in some cases, if these are strategies that are available to you, you should reassess what you're doing. If you've got excess money that you could prepay expenses, why aren't you investing that money? If you've got, losses in your stocks, what are you doing? Is that the right approach to investing in the stock market? So hopefully you found this helpful. If you did, please like the video and subscribe to the channel.